Hey everyone, in today's video, we're talking about the differences between mutual funds, index funds, and ETFs. When I first started investing, I was so overwhelmed by these terms, and honestly, the blur of confusion just seemed to grow thicker with every mention of these funds. And it made me feel really anxious about potentially making a costly mistake. I don't want that for you because mastering these terms could save you a ton of money and help you set yourself up for financial success. By the end of this video, you'll have a clear understanding of what mutual funds, index funds, and ETFs are and how they differ. And at the end, I'll also share my thoughts on which one I think might be your best bet. Let's dive in. To really understand these funds, I think it helps to have a bit of context on what the investing landscape looked like before these existed. So let's briefly rewind back in time. There you go. Way back in the day, I'm talking the early 1900s, the only way people could invest in the stock market was by handpicking individual securities or paying somebody else to do it for them. And this was not easy. To start, both options required a substantial amount of capital to even participate. And on top of that, the lack of widespread knowledge and resources made it difficult for people to research and make well-informed investment decisions. Even if someone had capital to invest, they often found themselves speculating on a single or small number of stocks, hoping for extraordinary gains. This strategy, as the saying goes, was akin to putting all your eggs in one basket, which was obviously extremely risky and frequently led to disastrous outcomes. As a result of these informational and financial barriers, only a privileged few with substantial wealth and connections could effectively engage in stock market investing during this era. But then mutual funds entered the scene. Mutual funds were among the earliest innovations that addressed these barriers and significantly increased stock market accessibility for a broader range of investors. So what are they? Mutual funds are a way for people to invest together. They work by pooling money from a bunch of investors, and then a professional fund manager uses this money to buy a range of investments like stocks and bonds. When you invest in a mutual fund, you're buying a piece of that fund. So while you don't directly own individual stocks or bonds, you do have an indirect stake in them through your ownership of the mutual fund. If the mutual fund's investments do well, your share of the fund is worth more. And if they do poorly, it's worth less. Mutual funds offer three main benefits for investors. First, instead of having to make investment decisions on your own, investing in mutual funds lets you outsource this to a professional. Fund managers research, select, and manage the fund's investments with the goal of generating profits that outperform the market while effectively managing risk. So you simply pick the mutual fund and they do the work. Secondly, to lower risk, fund managers spread your money across a basket of many different investments. This is important because if one investment in the basket doesn't do so well, others can make up for it. Diversification was a foreign concept and difficult to achieve for individuals prior to mutual funds. Thirdly, buying individual stocks and bonds is complex and costly, with lots of transactions and associated fees. Mutual funds make it easy by letting you indirectly invest in a variety of assets with a single mutual fund purchase. To sum that up, by pooling the money of many investors together and leveraging the expertise of a fund manager to manage the investments, mutual funds provide a simple way for everyday folks to access a diversified and professionally managed investment portfolio without needing a ton of money or in-depth market know-how. Pretty cool, right? But there's a catch. While the benefits are appealing, professional management doesn't come for free. The active management provided by fund managers comes with a cost. Management fees. These fees can range from 1% to 2% annually and can eat into a significant portion of your gains. What's more is there's no guarantee that the manager's decisions will yield positive results, and even if the value of your investments decline, you're still on the hook for the fees. This left some wondering whether the fees investors were paying for active management were justified, and if there might be an even simpler and cost-effective way for people to invest. And this is where index funds were born. Meet John Bogle, the founder of Vanguard Group. Bogle had a vision to create a new investment approach that offered similar advantages of traditional mutual funds, but enabled investors to keep more of their money. And you know what? He did it. And it forever changed the way people invest. His solution was twofold. The first was to eliminate fund managers from the equation and rely on computers to pick investments instead. And the second was based on a simple yet groundbreaking idea. Instead of trying to outperform the market's performance, why not aim to match it instead? How do you achieve market matching performance? You invest in the assets that make up a market index. A market index is essentially a list of selected securities, such as stocks or bonds, that are used to represent the overall performance of a given market. There are many different market indexes. For example, the S&P 500 is a list of 500 of the largest US companies and represents the overall performance of the US stock market. Across the globe, you have the Nikkei 225 index, which is a list of 225 major Japanese companies and represents the overall health of the Japanese economy. You may also be familiar with the Nasdaq, the Dow, the ASX 200, or the FTSE 100. These are all indexes, each representing its respective market. Bogle's visionary thinking led to the creation of the first ever index fund in 1976. The Vanguard 500 Index Fund, which aimed to track the S&P 500 index, and it was a hit. Today, there are many index funds available on the market, and here's how they work. Like traditional mutual funds, index funds also work by pooling money from a bunch of investors, but instead of relying on a professional fund manager to actively select investments, it leverages technology to automatically invest in the assets that make up a chosen market index. So in the case of the Vanguard 500 Index Fund, because it aimed to track the S&P 500 index, it would automatically invest in the 500 largest US companies. When you invest in an index fund, you're essentially buying a share of that fund. So while you don't have direct ownership of the individual stocks or bonds, you do have indirect stake in them through your ownership of the index fund. The value of your index fund shares rises when the index it tracks performs well, and the value declines when the index performs poorly. Essentially, your returns closely mimic the overall movement of the chosen market index. Summing it up, index funds are a type of mutual fund and offer similar benefits like diversification and simplicity. What sets index funds apart is that they're passively managed. By replacing fund managers with computers, Bogle was able to eliminate many of the expenses associated with traditional mutual funds, making index funds a more cost-effective option. Fees associated with index funds can typically be as low as 0.04%, allowing investors to keep more of their money. These days, you can even find some funds that charge no fees. So the question is, does lower fees mean lower quality? No, not at all. In fact, in 2007, Warren Buffett placed a $1 million bet that passive index investing would outperform actively managed investing over a 10-year duration. And you know what? He won. All the research and all the data shows that passively managed index funds outperform actively managed mutual funds over the long term. And this is what makes passively managed index funds so awesome. Now let me introduce ETFs. ETF stands for Exchange Traded Funds. They emerged in the early 1990s, and you can think of them as the younger, more flexible sibling of index funds. They are very similar to index funds in that many of them simply track a market index. So like how the Vanguard 500 Index Fund tracks the S&P 500 index, there's also a Vanguard S&P 500 ETF that tracks the performance of the S&P 500 index. So what on earth is the difference? There are two features that set ETFs apart. First, they're even more accessible. Unlike traditional mutual funds and index funds that can sometimes have a minimum initial investment requirement, you can leverage fractional shares to invest in ETFs with as little as $1. So for example, Vanguard's S&P 500 index fund has a minimum investment requirement of $3,000, but you could invest in the ETF equivalent with whatever you have to spare. The second way ETFs are different is that unlike traditional mutual funds and index funds, which trade once a day, you can buy and sell ETFs throughout the day while the stock market is open. You can basically trade ETFs like you would an individual stock. This gives you more flexibility and control. If you're an investor that wants to take a buy and hold approach to investing, this feature isn't going to be that valuable to you. But it's a question you have to ask yourself. Do you really need round-the-clock tradability offered by ETFs? Bringing it all together, Actively managed mutual funds were the first step in making diversified investments accessible to everyday people. But by virtue of them being professionally managed, they can be costly. Index funds then stepped in, offering a passive and cost-effective way to match market performance. And then came ETFs, which offered investors greater flexibility. So what's my take? Based on everything we've talked about, I'm sure you can guess I don't invest in actively managed mutual funds. They may have been a great innovation back in the day, but today there are much better options available. Whether you invest in passively managed mutual funds, i.e. index funds, or ETFs that track the market, really comes down to your personal preference. Their benefits are very similar, but personally I lean towards index funds because of their passive management approach, where I don't have to constantly think about my investments. Notably, platforms like Fidelity and Vanguard only facilitate automated investing with index funds, not ETFs. And as a buy and hold investor, the fact that ETFs can be traded around the clock isn't a feature that's appealing to me. That said, an ETF could be a good option for you if you want the trading flexibility, or if you don't have enough money saved up yet to meet the minimum requirement on an index fund. You really can't go wrong between the two, and again, it really just comes down to personal preference. I would love to hear your thoughts in the comments. Which of the three options would you prefer? If this video helped you understand the differences between mutual funds, index funds, and ETFs a bit better, don't forget to give it a thumbs up and hit the subscribe button for more simplified financial content like this. Thank you, and see you in the next video. Bye for now.